Section 1. What is an index fund? An index fund is an investment fund designed to copy a specific market index, such as the S&P 500. That means it automatically holds the same companies in the same proportions as the index itself. By purchasing just one index fund, you instantly gain exposure to hundreds of businesses, including giants like Apple, Microsoft, Amazon, Google, Meta, Tesla, Nvidia, and many more, without needing to analyze or select any company individually. This creates powerful diversification because your money is spread across the entire market rather than depending on one stock to perform perfectly. If one company drops, the others help balance it out, which gives you more stability and reduces emotional stress. Index funds follow the market instead of trying to beat it, and over long periods of time, markets have historically grown despite recessions, crashes, and chaos. That is why index funds are considered one of the simplest and most effective long-term investing tools for educational purposes. They also have very low fees because they require almost no active management. This means more of your money stays invested instead of getting eaten by expenses. Mr. Whiskers learned this when he tried to pick stocks based on cute logos and ended up losing half of his snack budget. After that experience, he said the words, "Boss, I think I finally understand diversification," and then immediately tripped over his own tail. Section 2. Why index funds matter. Index funds matter because they allow regular people to participate in the long-term growth of the market without needing specialized knowledge, predictions, or constant decision-making. Before index funds existed, most investors used actively managed mutual funds that charged high fees and often underperformed the market. Index funds changed everything by offering a low-cost, transparent, and rules-based approach. Instead of relying on a manager's opinions, index funds simply track the performance of the entire index. This approach removes emotions, removes guesswork, and removes unnecessary complexity. It also helps people avoid common mistakes like chasing the latest trend, panic selling, or flipping between different strategies every time the news changes. Index funds matter because they democratized investing. They gave everyday investors access to broad market returns with minimal barriers and minimal cost. Even Mr. Whiskers realized this after trying to run his own hedge fund out of the laundry room. He charged himself management fees and then forgot he was the client. That is when he retired from active management permanently. Section 3. How index funds work. Index funds work in a simple and predictable way. When you invest in an index fund, the fund automatically spreads your money across all the companies inside the index it tracks. If Apple makes up 7% of the index, 7% of your investment goes into Apple. If Microsoft makes up 6%, 6% goes into Microsoft, and so on. The fund does not try to pick winners. It does not make predictions. It simply mirrors the index. As companies rise or fall in market value, the fund adjusts automatically. When new companies join the index, they get added to the fund. When companies leave the index, they get removed. Index funds also calculate their price once per day at something called the net asset value, or NAV. This means if you place a buy order at 10 in the morning, you will not get the 10 in the morning price. You will get the price at the end of the day when all trading is finished. This system prevents impulsive trading and keeps the investing experience calm and structured. Mr. Whiskers appreciates this feature because whenever he can trade instantly, he becomes emotional and dramatic. He once yelled, "Sell everything!" I saw a red candle, and then realized it was a reflection from his laser toy. Section 4. Index fund fees and why they matter. Fees can make or break long-term investing, and this is where index funds shine. Because index funds are passive and simply track an index, they do not need large teams of analysts or expensive managers making frequent trading decisions. This keeps fees extremely low, often between 0.05% and 0.2% per year. In contrast, actively managed funds often charge 1% to 2% annually, which may sound small but compounds into enormous losses over long periods of time. A 1.5% fee taken every year for decades can quietly devour thousands of dollars of potential growth. Index funds avoid this issue by keeping costs tiny, letting compounding work at full strength. Mr. Whiskers learned about fees after he accidentally subscribed to a cat toy delivery service without realizing it charged him every week. When he looked at his bank balance, he said, "Boss, fees are the real villains," and I told him he finally understood personal finance. Section 5. Index Fund Myths and Misunderstandings. There are many myths about index funds that confuse beginners, so let's clear them up. First, index funds do not always go up. They follow the market, and the market has bad years. They drop during recessions, just like everything else. Second, index funds are not only for beginners. Some of the world's wealthiest investors use them because they are reliable, efficient, and mathematically sound. Third, index funds are not risk-free. They reduce risk through diversification, but they cannot eliminate it. If the whole market falls, the index fund falls too. Fourth, index funds are not guaranteed to outperform everything. Sometimes individual stocks or sectors outperform. The strength of index funds is consistency, not fireworks. Fifth, you do not need large amounts of money to start. Many brokerages allow fractional investing with small amounts. Mr. Whiskers once invested $4.17 in his first index fund and then strutted around the house like he owned a financial empire. Clearing up these myths helps you understand what index funds truly are. Simple, diversified, long-term tools for broad market exposure. Section 6. What is an ETF? Now let's talk about ETFs, because this is where things become faster, more flexible, and slightly more chaotic. An ETF, or exchange-traded fund, is similar to an index fund because it can also track an index and provide instant diversification across hundreds of companies. The key difference is that ETFs trade on the stock market just like individual stocks. You can buy or sell an ETF at any moment during market hours, and the price changes throughout the day based on supply and demand. Index funds only update their price once per day, but ETFs move up and down constantly. This gives you more control and flexibility if you want it, though you may not need it. ETFs also tend to have low fees, and many brokers allow fractional ETF shares so you can start with a small amount of money. Mr. Whiskers loves ETFs because he likes pressing buttons and seeing instant results. Unfortunately, this led him to try an intraday scalp trading strategy he invented called Pounce and Panic. It did not end well. Section 7. How ETFs work. ETFs work by holding a basket of assets and trading shares of that basket on the stock exchange. When you buy an ETF, you are buying a share of the overall portfolio. The price you pay is the current market price at that exact moment. ETFs fluctuate throughout the day because investors are constantly buying and selling them. Behind the scenes, there is a creation and redemption process that keeps ETF prices close to the value of their underlying assets, but you do not need to understand these mechanics to use ETFs effectively. The important thing is that ETFs give you real-time flexibility, real-time pricing, and real-time control. Some people love this. Some people never use it. Mr. Whiskers abuses it. He once bought an ETF at 9:30, sold it at 9:30 and 30 seconds, then bought it again at 9:31 because he saw a green candle. That is why ETFs require discipline, even though they are incredibly powerful tools. Section 8. ETF varieties and why they matter. ETFs come in so many varieties that even experienced investors get overwhelmed scrolling through the lists, and Mr. Whiskers once physically fell asleep on top of the keyboard while trying to choose between 4,000 different options. The massive variety of ETFs is one of the main reasons they became so popular. For example, broad market ETFs give you exposure to entire markets like the S&P 500, the total U.S. market, or international stocks. These funds hold hundreds or thousands of companies and create instant diversification. Sector ETFs focus on specific parts of the economy such as technology, healthcare, energy, finance, or renewable energy. You can target any specific industry if you want more concentrated exposure, although it is important to understand the risks because sectors can rise and fall quickly. Bond ETFs give access to government bonds, corporate bonds, and municipal bonds, creating more stability for people who want less volatility. Commodity ETFs allow exposure to gold, silver, oil, natural gas, and other physical assets without having to store anything. International ETFs let you invest in Europe, Asia, emerging markets, or global blends. Thematic ETFs track trends like artificial intelligence, robotics, cybersecurity, clean energy, or space exploration. Dividend ETFs hold companies that consistently pay dividends. As you can see, ETFs come in every flavor imaginable, from plain vanilla to wild experimental flavors that Mr. Whiskers would name like Tuna Futures Enhanced Strategy. Variety gives you flexibility to personalize your portfolio, but variety can also be dangerous if you choose funds without understanding what they hold. More options is helpful, but only when used with clarity and education. Otherwise, you end up like Mr. Whiskers, who once picked an ETF simply because he liked the font on the label. Section 9. ETF tax advantages explained. Simply, ETFs are often considered more tax efficient than index funds in certain countries due to how they handle the internal movement of assets. While you do not need a deep understanding of the creation and redemption mechanism, the key idea is that ETFs typically trigger fewer internal capital gains events than traditional index funds. Fewer taxable events inside the fund can translate into fewer taxable distributions passed on to investors. This does not mean you avoid taxes. In many countries, when you sell an ETF for a profit, you still owe taxes. But some ETFs reduce the annual drag caused by taxable distributions within the fund. This difference can add up over years. In the United States, this tax efficiency is especially praised. In other countries, the tax rules may treat ETFs and index funds the same, so there is no major advantage. That is why understanding your local tax laws is important. These differences are structural and mechanical, not magical shortcuts. Even Mr. Whiskers paid attention during this part because he cares deeply about keeping more of his tuna money. He once misinterpreted a tax article and thought ETFs made him immune to all taxes. When reality hit, he walked around the house dramatically for 2 hours, pretending he had been betrayed. The point is, ETFs can be more tax efficient in some regions, but not universally. Always check what applies to you. Section 10. ETF myths that mislead beginners. There are many myths surrounding ETFs that lead beginners in the wrong direction, so we need to clear them up. One myth is that ETFs are always cheaper than index funds. That is not true. Many ETFs are cheap, but some have high fees, especially thematic or actively managed ones. Another myth is that ETFs are safer because they trade during market hours. Trading flexibility does not influence risk. The underlying assets determine risk, not the fact that you can buy or sell instantly. A technology ETF can still drop sharply, even if it is flexible. A third myth is that ETFs always perform better than index funds. Performance depends on what each fund tracks. An ETF that tracks the S&P 500 will perform almost identically to an index fund that tracks the S&P 500. A fourth myth is that ETFs require active trading. That is not true. You can buy and hold them exactly like index funds. Many long-term investors use ETFs without trading frequently. Mr. Whiskers does not understand this concept. He treats every ETF like a hot potato and sells it as soon as he gets bored, which is usually within 7 minutes. Another myth is that all ETFs are well diversified. Some ETFs only hold a small number of stocks or focus on very narrow themes. These are not diversified and can be very volatile. The final myth is that ETFs eliminate taxes. They do not. They simply create fewer internal taxable events in some cases. Clearing these myths helps you understand ETFs more clearly and prevents confusion or mistakes driven by assumptions. Section 11. Active versus passive ETFs. ETFs come in two main categories, passive and active, and understanding the difference is essential. Passive ETFs track an index. They are simple, rules-based, and low cost. They aim to match the index, not beat it. Active ETFs, on the other hand, have managers making decisions about what to buy and sell. They are trying to outperform the market. They analyze companies, adjust weights, and rebalance constantly based on strategy. This sounds impressive, but active management has challenges. Over long periods, most active managers struggle to consistently outperform the index. The market is extremely competitive, unpredictable, and influenced by countless variables. Even when an active ETF performs well, higher fees often reduce the advantage. Passive ETFs offer stable, predictable exposure with higher reliability. Active ETFs offer potential outperformance, but also greater uncertainty. Mr. Whiskers once launched his own active investing strategy called symmetrical ticker theory. He said he would only buy companies whose ticker symbols looked balanced. He bought WM, which he claimed had perfect symmetry. The investment dropped quickly. He immediately blamed the moon. Understanding active versus passive ETFs helps you avoid being persuaded by flashy marketing. Simplicity and low fees often win over decades, but active funds exist for those who want a different approach. Section 12. Liquidity and trading mechanics. Liquidity refers to how easily and quickly an asset can be bought or sold without significantly affecting its price. ETFs generally have strong liquidity because they trade on major exchanges all day. When an ETF has high trading volume, you can buy or sell it quickly at prices close to its fair value. If an ETF has low volume or is obscure, liquidity may be weaker, meaning your trade might move the price more than you expect. This is why checking the trading volume of an ETF is important if you plan to trade frequently. Index funds do not have this issue because they do not trade throughout the day. They settle once per day at the net asset value, regardless of intraday activity. The difference in trading experience is fundamental. Index funds give you a calm, predictable once-per-day update. ETFs give you real-time control and real-time movement. Some people appreciate this control while others do not need it. Mr. Whiskers takes advantage of liquidity in the worst way possible. He once bought an ETF, sneezed, panicked, and sold it immediately because he thought the sneeze was a sign. Liquidity is helpful, but only if used responsibly. Understanding trading mechanics helps you decide whether intraday movement is something you care about or whether you prefer the simplicity of once-per-day pricing. Section 13. Which one is safer? Safety is one of the most common concerns for new investors, so let's address it directly. Neither ETFs nor index funds are inherently safer than the other. Safety comes from what the fund invests in, not from whether it is an ETF or an index fund. If both track the S&P 500, both have essentially the same level of risk. If both track technology companies, both are tied to the same sector volatility. The structure of the fund does not determine safety. The underlying assets do. Diversification is what reduces risk, not the wrapper. A broad market ETF or index fund is safer than a narrow, highly concentrated ETF. The only subtle difference is behavior. ETFs fluctuate throughout the day. Index funds update only once per day. Some people find ETFs more stressful because the price moves constantly. Others prefer the flexibility. Mr. Whiskers finds ETFs far too stimulating. He stares at the screen and shouts commentary like a sports announcer. Then he panics and hides behind the couch. Safety depends on the index, the sector, the diversification, and your time horizon. The structure simply determines how you trade. Section 14. Which one is cheaper? Fees are crucial for long-term wealth building, and understanding which structure tends to be cheaper can help you choose wisely. Both ETFs and index funds can have very low expense ratios. Many index funds charge between 0.05% and 0.2% annually. Many popular ETFs charge even less, such as 0.03%. But some ETFs, especially thematic or actively managed ones, can have much higher fees because they require constant management. The average cost depends on the specific fund, not the category. Trading costs can also matter. Some brokers charge commissions for buying or selling ETFs, but many platforms today are commission-free, making this less of an issue. Index funds usually have no trading commissions at all. However, expense ratios matter far more than trading fees because they are charged every year and compound over time. A small difference in annual fees can result in large differences in long-term returns. Mr. Whiskers learned this when he realized he had accidentally subscribed to a monthly cat treat delivery service that quietly drained his account. He looked at me and said, "Boss, these fees are worse than market volatility." Choosing low-cost funds helps your investments grow with fewer obstacles. Always check the expense ratio because it affects your results every year you stay invested. Section 15. Which performs better over time? When people ask which performs better, ETFs or index funds, the truth is much simpler than it seems. If an ETF and an index fund both track the same index, their long-term performance is almost identical. The performance comes from the index itself, not the wrapper around it. Whether the fund is structured as an ETF or an index fund has very little effect on the actual returns. What truly matters is what the fund invests in. If they both follow the S&P 500, they rise and fall together. If they both follow the total stock market, they behave the same. Any tiny difference between them typically comes from minor fee differences or trading mechanics, but these differences are usually so small they do not affect long-term results. The real driver of performance is broad market growth over time, not the type of fund. This is an important educational concept because many beginners think one format is automatically better. But the key factor is the underlying index and your discipline as an investor. Mr. Whiskers once asked me which one would make him rich faster. I told him, neither fund is a magic speedboat to wealth. Consistency, patience, and long-term investing are what actually create growth. He looked disappointed for 3 seconds and then walked away to knock something off a shelf. That is the difference between logic and instinct. Section 16. Building a portfolio using these tools. Building a long-term portfolio using ETFs and index funds is simple, flexible, and extremely effective for educational purposes. One of the most common approaches is using a broad market index fund, or ETF, as the foundation. These funds track hundreds or thousands of companies and give you immediate diversification. On top of that, you can add bond funds or bond ETFs if you want more stability. You can add international exposure to diversify globally. You can include dividend-focused funds if you prefer income-driven strategies. You can add sector or thematic ETFs for small targeted positions if they align with your goals and risk tolerance. Some investors build portfolios using only 3 funds, creating a simple and efficient structure. Others create more detailed portfolios with 5, 10, or more funds. The idea is to match the portfolio to your personal goals, time horizon, and comfort level. Mr. Whiskers once built a portfolio with 17 ETFs because he said the number 17 felt lucky. 17 was not lucky. His portfolio looked more like a shelf of random purchases at a dollar store. The important thing is that your portfolio should be intentional, diversified, and aligned with your educational understanding of risk. ETFs and index funds allow you to build a strong, balanced strategy without needing complicated trading or advanced analysis. Section 17, Mr. Whiskers' investing mistakes you should avoid. Now we need to talk about the mistakes Mr. Whiskers made so you can avoid them. The first mistake was buying an ETF without checking what it held. He bought an ETF with the ticker PAW because he assumed it stood for Pet Appreciation Worldwide. It actually tracked oil companies. He was stunned. The second mistake was confusing diversification with duplication. He bought multiple technology ETFs thinking he was building a diversified portfolio, but all of them held the same companies in different proportions. Instead of reducing risk, he multiplied it. The third mistake was trading out of boredom. Whiskers cannot sit still. He bought an ETF, sold it 30 minutes later, and bought it back an hour after that for no reason other than wanting something to do. The fourth mistake was chasing performance. He once saw an ETF that was up significantly for the year and assumed it would continue rising forever. The next week it corrected sharply, and he dramatically blamed lunar gravity for the drop. The fifth mistake was ignoring fees. He bought an ETF with a high fee because he liked its name. When he saw how much the fee took away from his returns, he declared that fees were the true enemies of wealth. The sixth mistake was investing emotionally. He once bought a clean energy ETF because he watched an inspiring documentary and felt passionately motivated. Passion is wonderful, but it is not the same as research. The seventh mistake was trying to time the market. He sat watching price charts for hours, waiting for the perfect moment to buy or sell, only to miss the opportunities entirely because he froze from indecision. These mistakes are funny, but they are also very real and common among new investors. Avoiding them helps you stay disciplined and focused on long-term strategy. Section 18. The Boss Investing Mindset. The boss mindset is the foundation of successful long-term investing for educational understanding. It means accepting that markets move in cycles. They rise, they fall, they fluctuate, and none of this is new or surprising. The boss mindset understands that long-term investing is not about reacting to every movement, but about staying consistent through the noise. It means recognizing that investing is not a race or a competition for instant results. It is a steady process of accumulating ownership in diversified investments over time. The boss mindset avoids emotional decision-making. It does not chase hype. It does not panic during temporary downturns. It does not get seduced by shortcuts or dramatic promises. It focuses on knowledge, discipline, clarity, and patience. Mr. Whiskers does not possess the boss mindset. He reacts to every fluctuation like it is a major life event. When the market dips 1%, he hides under the bed. When it rises 2%, he demands a celebratory treat. The boss mindset is calm, consistent, and long-term focused. It understands that investing success comes from time, discipline, and rational thinking, not from lucky guesses or dramatic reactions. Section 19. The long-term advantage explained. Simply, the long-term advantage is one of the most important principles in all of investing. Markets have historically grown over decades, despite setbacks, recessions, crises, and unpredictable events. When you invest in broad, diversified funds like index funds or ETFs, you benefit from this long-term upward trend. Even though short-term fluctuations can feel chaotic, the long-term movement has shown resilience as companies innovate, expand, and create value. Time smooths out volatility. Time transforms small gains into large ones through compounding. Time rewards patience more than precision. This is why long-term investing is so powerful for educational purposes. You do not need to time the market. You do not need to guess which stock will be the next superstar. You participate in broad growth and let compounding work for you. Mr. Whiskers does not understand this concept. He reacts to every small dip as if it signals a global collapse. He once saw a 0.5% drop and declared that the financial world was ending. 10 minutes later, the price had recovered, and he pretended he never said anything. Long-term investing removes the pressure of short-term noise and replaces it with steady, consistent progress. Section 20. Which one fits different types of investors? Choosing between ETFs and index funds depends on personal preference, educational understanding, and your desired experience. If you prefer simplicity, minimal decisions, and do not care about intraday trading, index funds can be an excellent fit. They settle once per day, have low fees, and provide broad diversification. If you prefer flexibility, want access to more specialized markets, or appreciate the ability to buy and sell at any moment, during market hours, ETFs might align better with your style. Many investors use both depending on their goals. For example, some place index funds inside retirement accounts while using ETFs in regular brokerage accounts because ETFs offer more variety and are easier to trade. The important thing is understanding what you own and why you own it. Mr. Whiskers does not follow this logic. He once asked, "Boss, which one guarantees wealth?" I told him nothing. Guarantees wealth, but disciplined long-term investing increases the probability of growth over time. He sighed dramatically, rolled onto the floor, and pretended to be unconscious. Matching your fund type to your goals helps you build an educationally sound, well-structured approach to investing. Final boss message. Boss, you now understand one of the most important distinctions in all of diversified investing. ETFs and index funds are both powerful tools. They both provide broad exposure, low costs, and simple entry points into the market. They differ mainly in flexibility, trading style, and variety. The choice is not about which one is universally better, but which one fits your goals, your timeline, and your comfort level. This entire script has been designed for educational and entertainment purposes only. It is not financial advice. Always do your own research and make decisions based on your own personal circumstances. Investing involves risk, markets fluctuate, and nothing is guaranteed. But with clarity, discipline, diversification, patience, and a long-term mindset, you can approach investing like a true boss. Stay consistent, stay focused, stay educated, and never invest emotionally like Mr. Whiskers, who treats every price movement like a dramatic plot twist. If you found this helpful, subscribe for more educational content and join the community of bosses learning how to think clearly, grow steadily, and build their knowledge one step at a time. I will see you in the next video, boss.